In this video, you will learn how to think in probabilities instead of certainty, discover how to leverage the statistical edge of each trade, understand why elite traders leave the fear of being wrong behind, and explore the pre-market ritual that ensures discipline even in the toughest conditions. We'll cover how to map out scenarios for every trade, manage position size and stop levels, apply mathematical expectations, and turn losses into valuable data to refine your methodology. When you fixate on immediate profit or loss, every candle becomes a vanity test, and the real risk is emotional rather than financial. Detaching from short-term outcomes means redirecting your focus to what you truly control, your decision-making process. Instead of treating each trade as a proof of competence, you begin to see it as a single step in a larger plan. This shift in perspective drastically reduces the emotional swings that often follow an unexpected win or a deep drawdown. Imagine two traders using the same setup. The first gets excited by a gain and increases his position size on the next trade. To maximize profits, when that trade goes against him, he hits his stop with more anger than necessary, because now the loss is amplified by a bruised ego. The second trader sticks to the original plan regardless of prior wins or losses. He evaluates the context, reviews his rules, and only enters again when the conditions present a new statistical edge. This detachment creates consistency. Average wins and average losses balance out in a predictable cycle. Free from emotional roller coasters. 2. Internalize this principle. Develop the habit of evaluating each trade on 3 levels. Execution: did you follow the plan? Risk management: was your stop and position sizing correct? And learning what new information emerged about the market or your own reaction. Immediate financial outcome takes last priority. When you accept that losing 1R is part of your method's expectation, the psychological impact of each drawdown diminishes. Even legendary traders like Paul Tudor Jones say the real profit lies in maintaining discipline and letting your capital speak for itself over the long term. A practical example comes from Linda Bradford Rasch, one of the few women who traded on the Chicago futures pit. Early in her career, quick wins made her so euphoric that she ignored her exit rules, and quick losses drove her into revenge trading cycles. The turning point came when Rasch began logging not her P&L, but her adherence to the plan. "Today, I followed my setup 100% and respected my stop." The result was secondary. By doing so, she stopped relying on the market to validate her confidence, focused only on what she could control, and achieved decades of consistent performance. Ultimately, detaching from short-term profit and loss frees your mind to trade with clarity. Each trade ceases to be an emotional event and becomes a data experiment. There is freedom in knowing you are not defined by a single trade but by the sum of all your wins and losses executed within your rules. That mental freedom is what keeps your psychological state stable when the market changes its mood, allowing you to continue applying your edge without fear or greed. The first step to trading like the top 1% is to accept that the market is unpredictable. Instead of trying to guess whether price will rise or fall, you learn to treat each trade as a probability test. This means seeing risk as part of the game and focusing only on the 2 things you truly control: position size and your exit point. Before every entry, mentally outline 3 scenarios. The optimistic scenario, where you hit your target; the neutral scenario, where your stop is hit; and the worst case, where a gap or strong adverse move occurs. Set clear stop-loss and profit target levels for each case. With this exit map in hand, you reduce anxiety and avoid impulsive decisions when the market moves quickly. The numerical foundation of this approach is expected value. Even if you're right only 40% of the time, you only need your average win to exceed your average loss to keep your account positive over the long run. For example, with a 0.4 probability of winning 2R and a 0.6 probability of losing 1R, your expectation is 0.8R per trade. Focus on refining that statistical edge, not chasing perfect win rates. In practice, take a few minutes before logging into your trading platform to verbalize something like, "My edge today is 55% to win 1R, risking 0.5R. Write that number in your notebook. At the end of the day or week, compare your actual results to those statistical goals. If you see you earned less than expected, don't blame bad luck. Adjust your method or risk management, not the setup itself. This simple habit turns every loss into a lesson. Traders like Jesse Livermore followed these practices. When a trade failed, he'd exit immediately, without trying to make it back on the spot. He knew that each loss was part of refining his method, not a penalty to be erased with more stakes. By embracing uncertainty, you stop reacting out of fear or greed and begin trading with confidence in your process, even when the market moves against your expectations. This is the mental foundation underlying all of Mark Douglas's principles, and it will set you apart on your journey to the top of the markets. In unpredictable markets, the only thing that truly matters is your statistical edge. That edge arises from your method, a tested set of entry rules, risk management parameters, an exit criteria that, over dozens or hundreds of trades, produces a net positive result on average. Trusting your edge means believing that, even after enduring a string of losses, your system's parameters will continue to generate consistent gains in the long run. This discipline is what separates the top 1% of traders from all the rest. 2. Understand why trusting the edge is so critical. Imagine you're using a setup with a 60% win rate and a 1R profit for every 0.5R risk. Statistically, in 100 trades, you'd have 60 winners of plus 1R and 40 losers of minus 0.5R, resulting in a net gain of 40R. Now consider the emotional impact if you hit 5 stopouts in a row. Monday begins with 3 losses. Tuesday adds 2 more. In that moment, the natural impulse is to doubt the system, tweak the rules, or increase risk to quickly recover those losses. If you give in to those instincts, you sabotage your own edge by altering the probabilities and needlessly risking capital. Trusting your edge requires 2 simultaneous skills. The first is faith in the math of your system, not blind faith, but a deep understanding of the numbers underpinning your method. Win rate, average profit and loss, frequency of opportunities, and the volatility profile of the asset. The second is emotional management, so you don't abandon your plan just when it needs consistency most. Legendary managers like Ray Dalio attribute part of Bridgewater's success to their insistence on following risk algorithm rules. Even in adverse markets, when the portfolio experienced significant drawdowns, they didn't tweak parameters in the heat of the moment. They trusted the models until the cycle turned. In practice, this means that, above all, you must document your edge with clear numbers. Use spreadsheets or backtesting software to verify that, historically, your setup works under current market conditions. Then implement a daily verification protocol. First, confirm that the trade you're about to place matches your tested statistical parameters. Only after that do you validate timing, size, and the macro environment. This process ingrains the habit of trading with not against your edge, preventing impulsive decisions driven by the desire to erase a loss to quickly. Real-world example is trader Tom Basso, famous for surviving high volatility periods without losing long-term capital. In interviews, he reveals that he suffered significant losses in 1987 and 2008 but never abandoned his original system. Instead, Basso temporarily reduced leverage according to his internal rules and let the edge play out, trusting that the method would recover from the drawdown. Once the market normalized, he returned to his usual position size and resumed his historically profitable averages. This approach shows that, in trading, losses are part of validating your edge, not a sign of trader failure. Trusting your edge also means accepting short-term randomness. For days, weeks, or even months, your method may run out of curve and generate more losses than wins. If you chase daily results, you'll abandon your edge just when it's being tested most. Rather than reacting to immediate losses, adhere to your risk framework, daily drawdown limits, maximum trades per period, and position size controls. These guardrails ensure that your edge isn't eroded by emotional decisions in the heat of the market. Finally, remember that a trader's consistency isn't measured by isolated trades, but by the series of operations over time. Trusting your edge is affirming that you are not defined by one bad day, but by the sum of correct decisions made within your plan. It is this unshakable belief, grounded in data, clear rules, and emotional control that separates the elite group able to generate real, sustainable profits from those still chasing miracles and getting lost in the market's short-term swings. The dialogue you maintain with yourself before, during, and after a trade is as powerful as any technical indicator. If thoughts like "this is going to fail," or "I've lost again, why even try," creep into your mind, they sabotage your focus and undermine the confidence needed to execute your plan. The first step in taming that inner voice is to identify it with mindfulness. Pay close attention to the thoughts accompanying every entry or exit decision, mentally noting whenever the voice of fear or doubt appears. A practical technique is pause and label. The instant you notice a negative thought, stop what you're doing and internally label the emotion attached to it. For example, you enter a trade and hear yourself think, "What if it turns against me?" In that moment, pause, take a deep breath, and mentally say, labeling, anxiety. This simple act of naming the emotion disarms its automatic power, creating a small gap between the stimulus and your reaction. Over time, that gap widens, giving rationale, critical thought, a chance to speak before emotion dictates your next move. After labeling, replace the sabotaging thought with a supportive phrase aligned with your process. Instead of "this is going to fail," tell yourself, "I applied my edge and I'm following my risk rules." This exercise must be repeated until it becomes automatic. A complementary tool is a mental script journal. At the end of each session, write down which internal phrases arose, classify them as sabotaging or supportive, and create action items to reprogram them. If you note, "I'm afraid of losing again 3 days in a row," craft a reinforcing phrase such as "losses are part of learning." and repeat it aloud before your next trade. Another strategy is the use of positive anchors. Each time you hit play on your trading platform, take 5 seconds to recite a powerful affirmation. For example, I am centered. My method speaks louder than my fear. This anchor conditions your brain to associate calm with a specific trigger. The act of opening the software. In time, even if sabotaging thoughts arise, your brain will automatically recall the anchor and recruit cognitive resources to regain control. Also, practice the dual perspective technique. Imagine observing yourself from the outside. If you were a coach evaluating an athlete, ask yourself, what would I say to that trader if I saw them hesitating? Referring to yourself in the third person reduces emotional load and facilitates more balanced responses, such as stick to your plan or the risk is already calculated. Psychological studies show that talking about yourself in the third person activates brain regions linked to self-compassion and self-control, making it easier to confront fears and doubts. To cement these changes, build checkpoints into your trading plan. Before each trade, add to your emotional checklist questions like, what phrase led me here? Is it truth or masked fear? If your answer reveals doubt, stop and apply, pause, and label until the mental substitution occurs. This protocol prevents sabotaging thoughts from slipping by unnoticed and ensures each entry is validated not only by the setup but by the appropriate internal state. Finally, remember that managing your internal dialogue is ongoing training. Even the best traders face voices of self-sabotage. The difference lies in the discipline to recognize and systematically redirect them. With time and practice, that inner voice will cease to be an obstacle and will become an early warning indicator, signaling exactly when to deploy your cognitive toolkit. It is this level of self-mastery that separates average traders from those who trade with unshakable conviction, even when the market defies all odds. Reaching the zone is not a mystical state. It is the result of preparing mind and body to operate at the edge between active consciousness and trained intuition. In that moment, the prefrontal cortex responsible for logical analysis, the unconscious limbic system, capable of rapid pattern recognition work in perfect synergy, enabling decisions that feel almost instinctive, yet are grounded in discipline and probability. Here's how to build this high-performance state step by step. 1. Physical and mental warm-up before your session. Reserve 10 minutes for a dynamic breath analysis technique. Seated at your desk, close your eyes and perform 5 cycles of diaphragmatic breathing. Inhale for 3 seconds, exhale for 5. Then open your eyes and, for 2 minutes, fix your gaze on a single object in the room, a mark on the wall, or a chart in slowed-down replay mode. This simple exercise synchronizes your cortex and thalamus, calibrating your attention level for distraction-free trading. 2. Zone activation rituals. Use a tactile trigger such as a crystal, the texture of your mousepad, or even a wristband. Use it before your first trade. For example, hold the object for 10 seconds while verbalizing, I am present. My edge guides my eyes. Pairing a sensory stimulus with a verbal anchor creates a fast neural pathway that, when activated, automatically evokes your trained mental state. 3. Narrow your focus. Traders in the zone do not chase dozens of assets. They concentrate on one market, one time frame, and one specific setup. Before you begin, select a single currency pair, stock or futures contract, determine your chart period, and limit the valid setups for the day. This specialization reduces cognitive noise and strengthens unconscious pattern recognition, freeing mental resources to analyze subtle price nuances. 4. Maintain peripheral awareness during your trade. Keep your peripheral vision active. Avoid fixating on tiny price movements or breaking news. Position two charts side by side, one at your entry time frame and one at the next higher time frame. Quickly toggling between micro and macro perspectives prevents automatic reactions to irrelevant fluctuations. This controlled alternation accelerates your unconscious processing of context, elevating the quality of each decision. 5. Micro breaks to sustain flow. Take 15-second micro breaks every hour of active trading. Simply look away for 10 seconds, take a deep breath, and return. Neuroscience studies show these brief pauses prevent prefrontal fatigue, keep dopamine levels balanced, and preserve mental clarity during long sessions. Top quantitative funds even schedule automatic reminders to enforce this practice, resulting in significantly fewer exhaustion-related errors. 6. Mid-trade confirmation. Incorporate a zone check-in during your trade. Whenever a position reaches half your projected target, for example, 0.5 R of profit, perform a mini confirmation ritual. Close your eyes for 2 seconds, touch your sensory anchor, and silently acknowledge, edge confirmed, I follow my process. This validation reinforces your unconscious confidence pattern and keeps your brain in continuity mode, not constant reassessment mode. Achieving and maintaining the zone requires daily practice, just as an athlete repeats their pre-competition routine. By combining breathing exercises, sensory anchoring, narrowed focus, time frame, alternation, and micro breaks, You train your brain to operate in the ideal state, fast, precise, and resilient to intense emotions. This is the pinnacle of trading psychology where analytical mind and data-driven intuition converge into decisions that feel instantaneous but are the fruits of relentless preparation. That obsession with immediate results erodes any discipline. When you place profit or loss at the center of your attention, you end up driven by greed after a win or paralyzed by fear after a setback. This emotional roller coaster destroys sequences of success and leads to overtrading or reckless entries. Instead of chasing profit peaks, focus on rigorous adherence to your process. Follow your entry rules. Respect your risk limits and execute your exit plan without question. This unwavering commitment to the method is what ensures consistency, because it transforms each trade into a single step in a controlled march, indifferent to the market's mood swings. Imagine you've predetermined that every trade may risk, at most, 1% of your capital in pursuit of a 2% gain. If, in one day, you see 5 setups but hit stops on 3 and profit on 2, your focus should be solely on how you applied your setup and managed risk, not on the final account balance. That means not increasing your lot size on the next trade or abandoning the method, but rather analyzing whether your entry criteria and stop calculations were correctly applied. Instead of saying, "I lost money today, I'll change strategies," you affirm, "I followed the rules today, and the results are the natural consequence of my edge." This attitude creates a virtuous cycle by reaffirming confidence in your process. You continue applying your method without emotional fluctuations, and your statistical expectation realizes itself over time. Top investment desks treat process execution as an uncompromising discipline. Rather than looking at daily P&L, they review execution consistency, how often the trader entered according to the rules, maintained correct position size, and adjusted stops when necessary. When professionals know their performance will be judged by process adherence, not just short-term profits, they preserve emotional flexibility even during adverse cycles. This process-driven culture fosters an environment where market fluctuations cease to intimidate, because they are seen as natural variability within a proven system. To incorporate this principle, turn your trading plan into an indisputable checklist before placing each order. Confirm: does the setup satisfy all criteria? Does the lot size respect the maximum risk? Is the stop positioned according to your methodology? Only after answering yes to every item do you execute the trade. After closing the position, record not the account value but your rate of checklist compliance. If you achieve 100% conformity, you've had a perfect process day, regardless of profit. This kind of metric trains your brain to value the habit of following rules instead of judging immediate outcomes. Over time, this continuous reinforcement builds robust conditioning. You no longer think, "How much will I make today?" but rather, "How well did I apply my method?" And, ironically, it is this complete dedication to process that ultimately generates consistent profits. When each trade is executed within specifications, the mathematics of your edge operates without emotional interference, and you organically join the elite group that builds wealth with unshakable discipline. The true differentiator of elite traders isn't merely executing orders with precision, but systematically extracting lessons from each trade. For this, the trading journal becomes your most powerful tool. It doesn't just document how many points you won or lost. It records the motivations, sensations, and thought processes that led you to enter, hold, or exit a position. This approach transforms each trade into a personal case study, enabling you to identify behavioral patterns, calibrate your edge, and above all, continuously evolve. Start by detailing the technical aspects of each trade: date, time, instrument, time frame, setup used, position size, stop and take profit levels, quantitative outcome, and win-loss ratio. Then devote an equally sized section to describe the emotional context. Ask yourself, what motivated me to enter at this moment? Did I feel anxiety, excitement, or doubt? Note physical sensations, racing heart rate, muscle tension, or shallow breathing. Finally, include your underlying rationale. Were my decisions based purely on price analysis, or was I influenced by news, social media chatter, or desk conversations? This 3-pillar framework technique, emotion, and reasoning reveals where your process succeeded or faltered. Consider Ed Seykota, a pioneer of systematic trading, who attributes much of his success to habitually reviewing his own behavior each day, rather than just the charts. Seykota kept brief notes on his mindset before every entry and discovered that, more often than not, he jumped into trades based on an emotional feeling, resulting in inconsistent performance. By feeding this insight back into his system, he refined his timing and drastically cut impulsive entries, boosting his win rate and profit-loss ratio. Another example is Van Keith Harp, who recommends analyzing expected value versus emotional response. Suppose your expectation was a 0.7R gain, but the trade yielded only 0.3R in your journal. Ask, Was this an execution issue, a position management error, or an unforeseen setup deviation? Simultaneously record how you felt upon realizing the underperformance. This correlation between mathematical expectation and emotional reaction highlights gaps in both your method and self-control, allowing you to make targeted adjustments before small mistakes become habitual losses. To reinforce learning, create insight categories, for example, timing errors, drawdown reactions, overconfidence after wins, or macro news influence. Each weekend, group your notes by these categories and calculate frequency metrics. How many times did fear delay your entry? How many trades were opened outside peak liquidity hours? These personal statistics map psychological and operational bottlenecks that backtests cannot reveal. Additionally, on a monthly basis, write a reflective summary. What were the 3 most valuable lessons learned? Which mental habits must you reinforce or eliminate? This macro review not only consolidates learning but also builds the self-confidence needed to stick to your process amid adverse cycles. Top hedge fund traders, such as those at Renaissance Technologies, perform corporate versions of this exercise. Reviewing execution reports focused 100% on process adherence rather than daily P&L. Finally, use your journal as a guide to excellence patterns. When you achieve 100% rule adherence and a positive balance on any given day, highlight what was different: mindset, preparation, market context. Those high-performance moments provide clues on replicating ideal behavior more predictably. As you accumulate these data points, your unconscious mind learns to seek not only winning setups but the entire suite of habits that precede consistent trading. In sum, learning from every trade demands the discipline to record technical details, the courage to expose emotional vulnerabilities, and the methodology to extract actionable insights. This ongoing cycle of journaling, analysis, and refinement is what enables a trader to evolve, adapting both their edge and themselves to the market's nuances. It is precisely this capacity for structured self-critique that underpins the performance of the world's top 1% of traders. Psychologically, our brain encodes patterns of success far more quickly when we celebrate small achievements than when we experience large, sporadic milestones. In trading, this means creating daily micro-victories that reinforce the habit of following your process, generating a sense of competence that cushions the impact of larger drawdowns. Instead of focusing only on 5R or 10R wins, rare events by definition concentrate on accomplishments you can repeat every day that validate your discipline, focus, and self-control. Start by defining simple, quantifiable daily goals. For example, commit to never exceeding your per-trade risk limit, to pause immediately after 3 consecutive losses, or to complete your emotional checklist on 100% of your entries. Each time you adhere to these rules, log it in your journal as a victory, regardless of whether you made or lost money. These small but consistent markers trigger light dopamine spikes enough to neurally reinforce correct behavior without creating tolerance and fuel the confidence that your edge works. Even on volatile days, consider a trader who spends 2 months avoiding every stop-loss violation but often finishes break-even, or with small losses. In the past, he would have felt defeated, but now he celebrates each error-free day. After 8 weeks, he has accumulated dozens of micro-victories. I understood my setup and respected the risk on 100% of trades. This steady record of controlling what depends on him builds an emotional resilience reservoir. When the first 5% drawdown arrives, he won't feel on the brink of despair. He'll remember, I followed the process perfectly for 20 days straight. I can ride out this cycle too. To make these micro-victories effective, create a visible discipline scoreboard. It might be a whiteboard next to your screen, or a highlighted section in your digital journal where each day you meet your key process goals earns a checkmark or point. This visualization turns trading into a consistency game, where the objective is to keep the streak of well-executed days as long as possible. Performance psychology studies show that simply seeing this streak activates the brain's reward system to seek behavioral continuity, making self-control increasingly automatic. Another pillar is establishing mini-success rituals. At market close, before turning off your screens, perform a brief ritual. Take a deep breath, stand up, and step back, mentally acknowledging that you met your standards of excellence. Even if the day's P&L is negative, this gesture strengthens the association between smooth execution and a sense of achievement. Over time, the brain begins to anticipate pleasure when it sees the rules were followed, turning discipline into a rewarding habit rather than a sacrifice. Finally, reinvest these micro-victories in micro-learning. Whenever you complete a streak of disciplined days, briefly review your journal and highlight the most valuable insight from that period. It might be a tweak to your trading hours, a breathing technique, or an easier-to-read chart pattern. In doing so, you not only reinforce correct behavior but also add new enhancements to your edge, creating a cycle of constant evolution. Building resilience through small victories is the art of training your brain to value the process above the market's ups and downs. It is on this foundation of daily confidence, built by well-executed habits, that patience, mental strength, and the courage to endure more intense drawdowns without losing direction will arise. In the next chapter, we'll explore how to combine these micro-victories with swing and position trading strategies to maximize results over longer time horizons. Before opening any position, spend a few minutes on a visualization exercise that primes your brain to trade with balance, regardless of the outcome. The most effective technique is the mental pre-mortem. Seated in a quiet spot, close your eyes and vividly imagine two scenarios. In the first, your trade follows the plan perfectly and hits the target cleanly. Feel the confidence and relief flow through your body. Notice the cold sweat on your brow. If that's realistic for you yet, recognize how your breathing remains steady. In the second scenario, visualize the price reversing immediately after your entry, hitting your stop and generating a loss. Observe the initial frustration, the tightness in your chest, and the automatic urge to get revenge. By bringing these sensations into conscious awareness, you reduce the emotional shock when they occur in reality, because your brain has already experienced and learned to identify and modulate that reaction. This process activates the same brain areas that would fire during an actual trade, creating a pre-recorded memory of the experience. In neuroscience, this is called neural teaching through simulation. By mentally rehearsing your responses, you strengthen the connections that govern self-control and attenuate exaggerated fear or euphoria. That is why it's crucial to invest daily time in this preparation. A simple protocol consists of 3 2-minute cycles, success failure, and a combination of both alternating between positive and negative sensations until each elicits only a mild emotional response instead of a visceral spike. Immediately after this mental warm-up, move on to the internal film director exercise. Imagine you are directing a movie about your own life as a trader. Watch yourself execute the trade and react to the win or loss, but allow an external voice to directors to comment in a neutral tone. "Well done, you stayed calm," or "Notice the tension in your right shoulder. We need to relax that muscle before trading." This distancing creates an internal observer who intervenes when emotion threatens to take control. With practice, this external voice becomes automatic. In the heat of the market, your brain will suppress the emotional impulse and activate rational criteria. Finally, combine the visualization with a brief physical ritual to seal the preparation. Before each session, hold a neutral object such as a smooth stone or a pen. Close your eyes and spend 1 minute mentally replaying the images of success and failure. When you open your eyes, take 3 deep breaths and tuck the object into your pocket. This simple gesture will anchor the trained mental state so that when you feel the weight of the stone, your nervous system automatically recalls the emotional equilibrium cultivated during the visualization. By incorporating these visualization exercises, you're not just planning scenarios on paper, but training your brain to respond predictably and calmly to any outcome. The next time the market reverses unexpectedly, rather than feeling shocked, you'll recall the prior simulation, activate your internal observer, and follow your process with the same clarity you had when you imagined the perfect trade. Mental resilience is what enables elite traders to maintain consistency, even amid the market's most abrupt swings. High-performance trading is not a final destination, but a continuous evolution process that demands brutal honesty with yourself. To remain among the elite, it is essential to set aside regular time for structured self-reflection, where you revisit not only your numeric results but the entire emotional and decision-making context that produced them. This habit transforms the trader from a passive rule follower into an active scientist of their own behavior. Begin by distinguishing 2 levels of analysis. At the first level, examine key metrics: win rate, average profit-to-loss ratio, and result volatility. Check whether these figures align with the expectations of your edge. At the second level, investigate mental patterns. Review your emotion and reasoning journals to detect trends. At what times of day did you feel most anxious or confident? Which news or events triggered sabotaging thoughts? In what situations did you violate your risk rules? This dual diagnosis uncovers discrepancies between your ideal plan and your actual execution, illuminating the areas that need adjustment. To make this process effective, establish 2 review cycles: a weekly cycle focused on micro-patterns, and a monthly cycle focused on macro trends. In the weekly review, devote 30 minutes to compare each day's checklist compliance with the results achieved. Identify the primary emotional trigger that had the greatest impact on your performance, whether overconfidence after a winning streak or hesitation. Before a classic setup, and create an improvement task for the following week, such as reinforcing your pause breathing technique or adjusting your daily trade limit. This short cycle keeps learning fresh and prevents small errors from taking root. In the monthly review, broaden the scope. Analyze performance charts and summarize up to 3 recurring strengths and 3 recurring weaknesses. If you notice, for example, that your risk per trade exceeds the target during high volatility markets, Consider whether the issue lies in position sizing or in insufficient volatility filters. If your win rate drops in the first hours after market open, investigate whether anxiety spikes or lack of preparation were factors. In each monthly meeting, adjust a single variable in your method to avoid overloading the change process. This incremental approach is inspired by agile methodologies where continuous improvements minimize the risk of emotional breakdowns. Beyond personal analysis, involve an accountability partner whenever possible. This might be a mentor, a trading colleague, or even a study group. Sharing your monthly summaries creates a powerful social commitment. Knowing someone else will read and question your conclusions raises your rigor and reduces the tendency to self-complacency. This dual validation self-assessment plus external feedback creates a safety net against cognitive biases that tend to distort our perception of reality. Another critical component is goal review. Immutable profit targets lead to stagnation or despair. Instead of setting rigid profit objectives, establish process improvement goals. Percentage of days with 100% checklist adherence. Number of tilt breaks taken, or number of entries after confirming your pre-trade visualization. By calibrating your goals around behaviors rather than financial outcomes, you generate cumulative learning effects and maintain motivation even during drawdowns. Finally, celebrate genuine progress. In each monthly review, acknowledge the small victories and continuous improvements, such as reducing stop-loss violations by 20% or maintaining your win rate above the statistical average for consecutive weeks. These recognitions reinforce the belief that the goal is not to win the next trade, but to build consistency day after day. Constant self-reflection, when incorporated as a non-negotiable ritual, as essential as your stop-loss, ensures that you not only react to market conditions but evolve alongside them. It is this sustained commitment to personal improvement, fueled by honest analysis and intelligent adjustments, that keeps elite traders firmly at the top, ready to thrive in any environment.